Let's talk a bit about yield in the fixed income markets. We've seen yield obviously rise largely most of last year, but the big question is where does it go? Where do we go from here? And in your view, what's the best way to invest across the curve in Nigeria?
Okay, one of the key drivers driving our market today is inflation and inflationary expectations. As you are aware, in recent times we've seen a partial removal of the fuel subsidy. So you've seen fuel prices go from 65 naira to about 97 naira.
Right.
Obviously, initially it was going to be way higher than that, and I think a lot of the prices had adjusted to the higher band or to the initial suggested price before prices were pulled back.
So we expect some significant inflationary pressure.
Yes, we expect almost a full effect.
What does that mean for yields, though?
Well, it just means that for now we have to stay at the short end of the curve, particularly where we expect yields to go up as well at the auctions. Yesterday, the DMO came out with the calendar for Q1 2012, and
right.
largely they're going to be issuing 10-year bonds, 3 of them in particular, in line with what the Minister of Finance said, aligning the liabilities of the country to the assets, i.e. using the funds raised from bonds to fund capital initiatives. With that in mind, I would expect that investors like myself should stay at the short end for now, whilst the yields go up slightly, ever so probably about 200 to 300 basis points. And then
what would
in the year we can
you just
take
mentioned
of these yields.
Right, David, sorry to cut in. You just mentioned that the 10-year bond is what is going to be on offer most of this year. But what does, strategically, how does that change things for people investing in bonds? How do you see that dynamic impacting the market? Because we know they've been investing in 3 to 5 years. They've been issuing more of 3 and 5 year bonds in the recent past.
Well, in recent times, in last year, we saw 3 and 5 year being issued. Towards the end of the year, we saw the introduction of 10-year bonds, particularly the 5S2 and the 6S2. And what we have seen in the yield curve is that the yield curve has been inverted, with 3-year instrument yielding between 15 and 16%, while at the long end, 20 years are yielding about 14% thereabout. With that in mind, I would like to think that I would stay at the short end of the curve. Should the yield curve revert to an upward sloping yield curve sometime later in the year, we will be able to we'll be poised to take advantage of those as well. So that is how we are likely to position our portfolios for now, remain short duration, and take advantage of opportunities in the T-bills market, as well as short-term government securities. Particularly, we like the 7S1, we also like the 8S1.
What's your take on the appetite of foreign investors for Nigerian bonds going into this year? We know it's waned a little bit last year, more so on the concerns around the value of the naira. What are your thoughts on how it will play out this year? I think those concerns still remain, even though some will argue that they are a little more moderate compared to last year.
I think the international scene, or the international investors, would have been a lot more poised if we'd seen the full effects of the removal of the subsidy. The implications for that really is greater accrual to FX reserves. One of the key things that we saw affecting investor confidence was we saw huge depletion in the FX reserves. Last year we opened at 30 billion and we closed just about 30 billion as well, $30 billion for FX reserves. Our import cover was diminished from a high of about 17 times to around 9 times. Though still fairly competitive, I would like to think that yes, the positive carry still remains, given Nigerian yields at the moment, but I still believe that foreign investors should remain cautious as well.
But let's compare them to the likes of Kenya, for instance. We know that their benchmark rate is somewhere around 18%, and obviously bonds would be priced generally above that. So But Nigeria's dynamics are obviously very different. In Kenya, there's still a lot of concern about the Kenyan shilling and where it will play, how to settle this year. Your thoughts on the case for investing in Nigerian bonds today?
Well, what you saw last year in the Kenyan shilling, they saw a large devaluation last year. With that, investors would have gotten a massive beating in the market, despite interest rates being at 18 or more percent. In the Nigerian scenario, we see a stable FX. The CBN has suggested a band of 155 plus or minus 3%. So that's where somewhere around 150 and 160.
You're confident that we will trade within that band?
I think that by upping the band, we've sort of removed some of the steam. However, I still expect the import demands to remain. Don't forget that we are an import-dependent country. However, with the partial removal of the subsidy and also a lot of light being shown on fiscal prudence and things like that, we expect that the government spending should be somewhat curtailed.
All right.
For that reason, I think that we should see some accrual to the FX.
So Nigerian bonds looking good for foreigners.
I think that.
All right. Thanks a lot, David. Let's leave it there. Thank you so much for your thoughts. That's David Alao.